If you're planning to retire early, you're probably already thinking about how to optimize your taxes. After all, the earlier you retire, the more you'll need to consider how to keep your money working for you without losing too much to taxes. It's a common challenge many retirees face, but with the right strategies, you can minimize your tax burden and protect your wealth for the long term. First off, one of the most effective ways to optimize taxes when retiring early is to consider tax-deferred accounts like a traditional IRA or 401k. If you've been contributing to these accounts during your working years, you can withdraw from them without paying taxes until you reach retirement age. But here's the catch. If you're retiring before age 59 and a half, you could face a 10% early withdrawal penalty. To avoid this, consider using a strategy called substantially equal periodic payments, or SEPP. This allows you to withdraw from your IRA or 401k early without penalty as long as you stick to the agreed schedule. It's a great strategy for early retirees who want to access their retirement funds early without losing a large chunk to penalties. But keep in mind, once you start withdrawing from your tax-deferred accounts, you'll be taxed on those withdrawals. This is why diversifying your retirement accounts is so important. One of the best ways to optimize your tax situation is by having a mix of tax-deferred, taxable, and tax-free accounts. For example, Roth IRAs are a fantastic tool for early retirees. With a Roth IRA, your contributions are made after tax, but the withdrawals are tax-free as long as you meet the required conditions. If you're looking for tax-free growth and want to avoid future taxes, opening a Roth IRA can be one of your best moves. If you already have a good amount in tax-deferred accounts, you might want to consider converting some of that money into a Roth IRA before you retire. This conversion would require you to pay taxes on the amount you convert, but it could save you money in the long run, especially if you expect to be in a higher tax bracket during retirement. By converting now, you can lock in today's tax rate and avoid higher taxes down the line. Another tax-saving move is to take advantage of health savings accounts, HSAs. If you have a high-deductible health plan, you may qualify for an HSA, which allows you to contribute pre-tax dollars to pay for medical expenses. Even if you retire early and are not yet eligible for Medicare, you can continue contributing to and using your HSA to cover medical costs, all while saving on taxes. Now, let's talk about a powerful tool to protect your wealth: gold IRAs. While diversifying with Roth IRAs and HSAs is important, one of the best ways to safeguard your wealth against market volatility and inflation is through a gold IRA. By investing in precious metals like gold, you not only protect your wealth from the effects of inflation, but you also secure a tangible asset that's known for maintaining value during uncertain times. If you're serious about protecting your wealth in the next 2 weeks, make sure to click the first link in the description to get your free gold IRA guide. This will show you why thousands of Americans are opening gold IRAs to protect their savings, especially when they retire early. When considering tax optimization for early retirement, it's also worth taking a look at tax-efficient investing. You might want to focus on capital gains rather than income, as long-term capital gains are taxed at a lower rate than ordinary income. And when it comes to your portfolio, holding assets for at least a year can qualify you for these lower rates. Keep in mind that tax-efficient investments like index funds or ETFs tend to generate fewer taxable events compared to actively managed funds, so consider these options to reduce your overall tax burden. Another point to consider is when to start taking Social Security. You can start as early as age 62, but your benefits will be reduced. If you can afford to wait until your full retirement age or even age 70, you can maximize your Social Security benefit and reduce the overall tax burden on your income. The longer you wait, the more you'll receive each month, so factor this into your overall retirement plan. Lastly, if you're thinking of withdrawing from your taxable investment accounts, be mindful of the capital gains tax. Long-term investments held for over a year are taxed at a lower rate, but short-term investments can be taxed as ordinary income. So, plan your withdrawals carefully to avoid unnecessary tax costs. Remember, optimizing your taxes when retiring early requires a solid strategy, one that blends tax-deferred, tax-free, and taxable accounts, along with careful withdrawal planning. And if you want to safeguard your wealth while enjoying the fruits of your labor, a gold IRA could be the perfect addition to your retirement plan. To learn more, click the first link in the description for your free gold IRA guide, especially if you have 100K plus in your IRA or 401K, or even 5M plus in savings. By taking these steps, you'll not only reduce your tax burden, but also ensure that your retirement is as comfortable and secure as possible. Make the right choices today for a smoother, tax-efficient retirement tomorrow.